Hello, everyone. Even more about mining stocks. I've got 3 or 4 videos about mining stocks. I keep doing these because I get a lot out of it. I've actually, the repetition, uh, it I think it makes my decision making better because lots of times decisions are made from the gut and they're real quick, and so it's good to have practiced thinking about it. That's the way I look at these videos. Anyway, this one, I've got 2 parts to it, and both should be less than 10 minutes. And with that in mind, I'll get moving here. Um, this is about the Huey Gold ratio, is what I'm using, and I'll put a link to that in the description. What it is, mining stocks to gold ratio. If you're watching, you probably already know all that stuff. Let me get real quick over here something to point and draw with. You can see right here that there's a wedge. And if you're familiar with trading, you know the wedge either breaks up this way or it breaks down. And so I'm going to zoom in on that wedge. And you can see the low point is right here. That's an absolute low over all time. And right here is where we had a crisis. The only thing I'd note about the crisis is that when there is a crisis, it stops its halt from going up, it looks like, and then it crashes and drops below any line that's been set up like this. So there's where it's touching and working. And I would call this working too. I'm just kind of noticing that, hey, it does overshoot a little both ways. So that's one good thing about the crisis. And the crisis I'm talking about is the COVID crisis from, well, at least showing up in the Huey, it was there from December 2019 to March of 2020, and that was it as far as the Huey was concerned. Of course, the Huey is way down at the bottom of the chart, so I think this is the more likely scenario. And this is unlikely, but yet we do have a crisis that's imminent. Um, and I'm talking about a crash in the stock market. And what these marks are here is I'm saying, well, I just don't see it going. It works its way up. Let's say the crash, I think this would be ideal too. I'm jumping around a little bit. Sorry about that. But let's say the crash occurred right there and this thing ticked up and hit that one. And instead of just going right through, the crash occurs, then I could see it being going down to here, which is the COVID low, or going beyond that, even down to here. So it's more of a horizontal target rather than an angled target like in a wedge. So um, I would think that would be the limit, just the absolute low. But it could be a horrible crisis. Maybe it goes just a little below that. But the problem is that there's, for it going lower anyway, it's not a problem. It's just that there's so many buyers when it drops down like that. So there's not a lot of room on the downside. So that's worth considering a little further. And I've plugged in some numbers here. This run from here to here is from 0.14 to 0.64. And here is the all-time low. And it just so happens by coincidence we're right when I copied these charts or took pictures of them within a few days ago, end of May. This was at 0.14, which is the same thing as it is over here. And let's continue. So what I'm going to do is calculate the most extreme reward potential. Not that I'm counting on that happening, because I might get out, as I'll show later, I don't know, I might switch out there, or pick your own number, uh, rather than try to hit an exact top, which is hard to do. So that's what you're going to have to do. I mean, that is the most extreme reward potential from there to there. And likewise, in order to make it apples to apples, let's see if I can find it here. The most extreme drop, as long as I do the most extreme that's available on the chart, I would think these would be a pretty logical equivalent way of looking at things, or a fair way is a better way of putting it. And that's just that drop right there, basically. So if I look at that and just look at it visually, that's what it looks like visually. And so the upside looks real good and the downside doesn't look that bad. So that's the risk on the bottom. And just to put a number with it, just to do some math, if you do that math, it's 3.6 times from 0.14 to 0.64 is 3 times gain, and here's a 0.29 loss. And just to even take the math a little further, that ratio is 12.4 of the upside to the downside. And this is probably something, this metric anyway, the upside to the downside ratio, might be a good way of evaluating stocks if you have, this type of information, historical, available. I'm looking at all mining stocks and the price of gold, which is a huge market. I don't necessarily think this might work with individual stocks, but I'm just trying to see which way the wind's blowing, and it looks like, I'd have the wind at my back if I, from here, at least until I get up to someplace right here, and or maybe try to ride it on out up to here. I have to wait and see. This might be plenty for me anyway. I like getting in when the risk is at a minimum and the reward's at a maximum. So that's that is all about. And that's about it, really. Let's see if that's less than 10 minutes. If it is, good to go, and good luck. And I'll see you on the next video. I've got a part 2 for this coming where I look at, just look for it. It's got more of a prediction in it, and it's also got some more math than this one does.